principal residence exemption has been changed by the CRA back in October, but we've just been getting some more details on it lately, and really this matters to anybody who owns a home, and it also has some far-reaching consequences for some others. Here to explain what happened and what you need to pay attention to, I'm joined by Tarsem Basraon. He is a high net worth planner with TD Wealth. It is great to have you here.
Thank you for having me.
What I wanted to do, if it's okay, is I just want to list out, if we could to start, just what the changes are, and then we'll get into detail on what each one of those changes is. So tell us, what happened, first off?
Sure. So there's a whole bunch of changes that were announced in October 2016. One is that there's a change for non-residents that are relying on a certain rule called the 1+ rule. There's a change for certain trusts that hold principal residence for beneficiaries, and then there's some reporting changes. So prior to these changes, there was an administrative position that basically allowed you to forego the need to actually report the capital gain and claiming the principal residence exemption when you sell your house. In the new rules, what they're requiring is that you actually report it. And as a result of that report, there's some consequences if you don't do the reporting. So there's some penalties if you late file, and also if you don't report, it could mean that they could reassess you beyond the normal 3-year reassessment period.
All right, let's start with the last one you did first and get to a little more detail on that. So if I own a home, a principal residence, and I sell it, I have to file, whereas before I didn't have to.
Correct. So in the new world, you have to file the a return, and in that return, there's a Schedule 3, which reports your capital gains and your capital losses.
Yeah.
And within that Schedule 3, you have to actually report the description of the property that you're selling, the year that you acquired it, and what the proceeds were for the sale.
Okay.
And if you fail to do that, there is a late filing penalty if you try to file it later, and that penalty is $100 a month for every month after the deadline, and up to $8,000.
That's significant.
It's very significant, and the other issue is that they've rushed this out and they've applied it for the 2016 taxation year. So that means that if you sold your house in 2016, even before October 2016 when the changes were announced, so if you sold in January 2016, when you file your 2016 tax return, you're required to report the sale of your house in your return. So when you file your taxes in April 2017, coming up in the next few months, you'll need to report that. So there is a lot of uncertainty about the way they're going to deal with that, because they have what they call a communication period. So Canada Revenue Agency is saying that we're aware that this was rushed out and we need to give people some leeway. So they've said that they won't file charge penalties if you forget to do it for your 2016 taxation year, unless it's excessive. But we don't really know what that means.
Err on the side of caution.
Yes, exactly. So you have to tell your accountant when you do your return that you sold the house, which traditionally in the last 20, 30 years, you would have never told your accountant that you're doing that.
Right, so now you have to. Now, if you hold 2 properties, if you hold a house, let's say, and a cottage, before, you could have just done it and you didn't need to tell anybody anything. And some people may have abused this as well. Now you have to declare, so there's clarity on which is which and what counts.
Correct. So the rules have not changed. You still can only have 1 principal residence per year. But the difference is that you have to then report it. So you had abuses. So you had situations where people were selling their house in 1 year. They wouldn't report it. They would sell their cottage in the next year, and they wouldn't report it, because the theory was that they, I'm going to claim the principal residence on both and maybe claim ignorance or something like that. But in these new rules, you're forced to do that. And the other thing that this is trying to get at is people that are buying properties for speculation. So a common strategy is people will buy a condo pre-construction in their child's name, and their child will be 18, 19 years old. And then when the condo has gone up in value in a few years, they'll sell that. And under the old world, they would just not, the child would not claim the principal residence exemption. But in these new rules, the child will have to fill out that form. And what will happen likely is CRA will say, you have a 20-year-old here with a $200,000 gain. And so did they really buy it to live there, or did they buy it for speculation?
Yeah, a lot more scrutiny. I've only got about a minute here left, but for the trust side of things, some people were also claiming a principal resident exemption within a trust.
Correct. So
they can't do that anymore.
Yeah, so they've limited that to only certain types of trusts. So there's spousal trusts, certain qualified disability trusts, trusts for minors where their parents are deceased. But generally, there was a strategy where you put the property in a trust for a child that had creditor issues or family law issues, you no longer have the principal residence exemption available in that situation.
And in 30 seconds, fantastic information we're packing all in here, but for non-residents, what was the change there too?
So the change there is that it doesn't affect anybody in Canada, but if you're a non-resident, you used to be able to get that +1 rule that I spoke about. That really applies when you sell and buy a property in the same year. It just ensures that non-residents will be subject to tax on their entire capital gain on the sale of a house.
I think everybody's ears perked up while you were talking. Tarsem, great information. Thanks so much for coming in.
Thank you for having me.
Tarsem Basraon, he's a high net worth planner at TD Wealth, joining me in studio.